Did you know that most technical analysis is done through either pure price action, like the Newton method, or done through indicators? Now, before you begin this lesson, make sure you've taken the Introduction to Technical Analysis course and the Price Action courses. These series of lessons will explore indicators. These squiggly lines on the chart can give your trading an edge. Indicators are, in fact, a great help in making informed trading decisions, and informed trading decisions carry less risk. So, what is an indicator? An indicator is supposed to give the trader buy, sell, or do nothing signals. That's the primary function. These indicators are based on price data. That's the open, the high, low, close of the stock. Now, frequently, indicators also include volume and open interest in calculations that give us different kinds of indicators. I'll give you an example. Since prices of stocks move up and down quite frequently, around the year 1901, a mathematician used closing prices, that's the price that a stock closes after the day ends, and used those prices to plot an average line. So just like we use the batting average in cricket to predict if the match is likely to win or lose, we use the moving average to gauge stock uptrend or downtrend. Simple. Very simple and yet very effective. Anyway, indicators are of two types. The first is the leading indicator and the second is the lagging indicator. Let's start by understanding leading indicators. As the name suggests, they are price leading indicators. That is, they're a bit ahead of the market's price action. The relative strength index, the stochastic, the parabolic SAR, and many more are some leading indicators. Now, essentially, what this means is that a leading indicator tells the trader the trend before it materializes in the market. Here are some attributes of leading indicators. First, they are oscillators. The RSI, for example, the relative strength index indicator, oscillates between 80 and 20, indicating overbought and oversold conditions. Now, these vertically collaborated extremities derive all of their calculation from the price, and they tell us an extended phase whether the market is likely to reverse from either side. Second is buy or sell signals. Now, the vertical oscillations actually give us buy or sell signals based on price. And the third, the nature is predictive. These leading indicators attempt to be predictive in nature. That is, they attempt to foretell the coming trend based on past market data. Now, this is truly a double-edged sword. If the indicator gets the prediction right, then the trader gets to make a lot of money because the real juicy movements occur at the initial stages of a trend reversal. And if the prediction turns out to be fake, which sadly is a likely event too, then the trader could lose a small fortune if he does not have his position size and money management in place. To summarize, the leading indicator is a mathematical attempt to remain ahead of price action in order to predict the outcome of the palm wrestling match between buyers and sellers. Let's move on to lagging indicators now. The simple moving average, the exponential moving average, the MACD, and a few others belong to the class of lagging indicators. Their signals to buy or sell lag behind the market trend just a bit because they first want to make sure that the unfolding trend is real. The lagging indicators tell the trader of the trend after it has materialized in the market to provide a confirmation. Some attributes to the lagging indicators is that they are crossovers and cross-unders. Now, lagging indicators move like a wave across the chart. Usually, there is a second indicator as well, which gives us a buy or sell. For example, here we have a cross-under before February signaling a buy, and the market's actually moved up. And then we have a crossover around April, signaling a sell, and the markets actually went down. The second thing is that they work great in trending markets. As they move horizontally, the direction of price action normally unfolds over a large area of the timeline. So the large area spanning the market information is what makes them quite efficient in trending markets. So sideways markets, not so much. They don't do so well there. And they are confirmatory in nature. Since the lag behind the price, they tend to be confirmatory. That is, before giving the signal, they check the validity of the unfolding trend in the market. Since these indicators lag, we lose out on the juicy spurt in the beginning of the trend and buy only after a decent rally. In short, the lagging indicator is a mathematical attempt to remain behind price action so as to first confirm the winning hand tilt in the palm wrestling match between buyers and sellers. Here are some points to remember. A leading indicator generates buy or sell signals from its vertical oscillations, and it tends to predict the coming trend. It's very useful in sideways markets and good for trading on shorter timeframes. And number 2, the lagging indicator. It generates buy and sell signals from the horizontal movement of its vertical oscillations, and it tends to confirm the unfolding trend before giving the signal, so it's slightly late. This makes it quite efficient in trending markets. This is great for positional and swing trading on higher timeframes. I hope this introduction helped you understand the basics of what indicators are. So now that you have a broad idea, we'll move on to the specifics of what an indicator does. In the next lesson, we will discuss the RSI, or the Relative Strength Index. I'll see you in the next lesson.